thank you for checking out the second edition of Public Finance Conversations for April of 2021. Once again, I'm here with Glenn McGowan, and we have like I said, our second question. In the infrastructure bill, there's a lot of discussion about Build America bonds. Build America bonds were a very successful tool used in the last economic downturn, or as we call it, the Great Recession. And these Build America bonds became known as BABs. BABs were a key instrument because short municipal rates were high. And so having a program where we had taxable bonds that had a 35% subsidy instead of just having high tax exempt rates made it so that we really brought down rates overall. And so it was a tool then. We're in a little bit different environment now where the municipal tax exempt rates are already low. So how it will apply may be different this time, but it still could be a good tool. So Glenn, if you wouldn't mind diving into how BABs might be helpful with the new infrastructure program.
So another great question. I think, the two things that are being discussed probably the most by market participants with this infrastructure bill are the inclusion of Build America bonds or some variant of it, as well as tax-exempt advance refundings. And I think each of those options, each of those strategies is a pretty powerful tool for our issuer base to unlock long-term capital at very cost-effective levels. And they sort of serve different purposes. Build America bonds, when they first came out in 2009 and 2010, basically afforded municipal issuers the opportunity to access subsidized capital and not be reliant on the traditional municipal investor base for that capital. In other words, we issued a product that sort of looked a little bit like a corporate bond, at least in the beginning it did. And we were able to tap into a broader universe of investors and enjoyed a broadening of that buyer base, which helped drive demand for the securities themselves and really had the positive impact over time of acquainting investors in other markets, whether it was mortgages or corporates or rates, what have you, with municipal credit. So at the end of that 2-year period, you had a broader universe of investors and frankly, a global universe of investors who became conversant with municipal credit. The impact of that was, again, providing lower cost capital for our issuer base. And the way many of those deals were structured, if you remember, was actually kind of a hybrid approach where you would dual track both a BAB and a tax exempt transaction on the same deal. Typically what would happen is the first 12 to 15 years of the yield curve would typically be done on a tax exempt basis where the comparative costs were lower. And then the long end of the yield curve was really more the purview of the Build America bond product, because once you accounted for the ratio of MMD to treasuries and where it made more sense to issue a tax-free bond versus a taxable bond, even on a subsidized basis, the serial range really drove that benefit for the issuers. The long end really became the main part of the curve where BABs were used. So I think if we were to get a reintroduction of BABs, probably you'd be looking at the longer end of the yield curve where I think you would see a little bit more bang for the buck there for the issuer base. There's no question that would provide yet another mechanism, another tool for our issuers to unlock cost-effective capital. And I think there's no secret that our issuer base really has a need for cost-effective capital, and there are a lot of infrastructure needs nationally that need to be addressed. So BABs, like they were the first time, could be a very powerful tool to provide that investment. What I think is interesting is also the potential for tax-exempt advance refundings, which again, I think over the last year, we saw a pretty significant uptick in taxable issuance to the point of being almost a third of the calendar. And in recent weeks, with the dislocation where, as we talked about before, treasury yields started moving higher at a faster pace than tax-exempt MMD yields, now we're actually seeing more tax-exempt forward transactions get done because in certain instances, they can actually be a little bit more cost-effective. Now, not every issuer is going to be willing to do those, but those are the tools we currently have. I think if you bring back tax-exempt advance refundings, you give our issuer base a very powerful tool that enables significant cost savings down the curve where ratios of a tax-free bond to a taxable bond are very tight, meaning that the comparative interest rates are lower and the issuer can get a comparative benefit. So obviously this all sort of depends on the political process in Washington, D.C., and that's going to take probably a period of at least several months to work out. It's sort of hard to predict and hang your hat on a political process that happens in DC. So we'll have to watch that very closely. But it does feel like for the first time in a long time, support for both BABs and tax-exempt advance refundings is being carried, being kind of supported by a broader universe of participants in the political process. That hasn't always been the case. So I think that's a positive trend.
You brought something up that's very interesting to me because I had not connected the importance of these two instruments, if you will. So we've had an increase of taxable bonds because we can't do tax-exempt advance refundings. But
Right.
now if this bill makes that possible, you take away some of the market of taxable, but then you could fill this in with BABs instead and maybe still keep that level of volume. I don't call it equivalent, but enough out there to keep the investor base satisfied with taxable bonds. Is that something you see as a possibility?
Yeah, I think that is definitely a possibility. And I think about, the market for a large infrastructure project, a long dated, taxable transaction in benchmark size, that's something that you could market to a global base of investors. And there's no question that there's significant participation and oftentimes managed form. Large U.S. money managers scouring the globe, accumulating large mandates on the part of global investors, putting that money into the taxable municipal market. That could be, with the Build America bond type product, a core outlet for supporting infrastructure investment. And then obviously with the tax exempt product returning, issuers will simultaneously have the opportunity to retire older vintage higher cost debt. So, I think both of those two things could happen at the same time. You could have a more cost-effective way of financing infrastructure projects and funding them to term on the long end of the yield curve, and then you can have a return, perhaps, of an instrument that enabled our issuer base to really lock in significant levels of savings for local communities. And I think, even though economic growth is certainly improving as a result of all the stimulus efforts, I think many of our clients would agree that if they have an opportunity to register some significant cost savings by refunding debt with a tax-exempt bond, if they were able to do that, they would go ahead and make that, make that decision. So I think very, very much worth watching how this bill plays out and what the process looks like. But I think it's could be a very good thing for our issuer base and for their credit quality in general.
Great. Thank you, Glenn, for taking time with us on our second question for Public Finance Conversations of April 2021.